Good morning. Happy Friday. It's Brett here, directors, with this week's Friday market recap. So, starting off, closing prices of the 10-year note. Monday, 3.621. Tuesday, 3.642. Wednesday, 3.685. Thursday, 3.74. And so far today, 3.757 is the current price. So the big focus this week, of course, was the Fed meeting on Wednesday, and they did, in fact, come out with a half-point reduction. Now, what came along with that is, hey, how come they did a half-point reduction and mortgage rates actually went up a bit? That kind of surprised the markets, and of course, I think surprised a lot of folks just out in the marketplace in general. So how come? Why did that happen? So a couple opinions from my side for us. So I think number one, guys, we got to remember traders are very speculative. So they're always trading in advance of something. So I like to look at it this way: is this reduction on Wednesday for the Feds was the first reduction they have done in 4 years. So this is the first time they've lowered rates in 4 years on their side. However, mortgage rates have improved almost 2% from the peak over the last year for us. So when some clients look, or some folks think, hey, the Fed really controls mortgage rates, well, then how come rates came down 2% before the Fed did anything? Well, a lot of it is the market speculating to say, okay, hey, we think the Feds are going to do this in the future. We think economic data is showing signs of potential recession and the market slowing down. So we saw rates come down significantly here the last, 3 months, but really even heavily the last 60 days. So this Fed move of a half point was almost more of a confirmation that the moves already taken place in interest rates were the right thing for us. So we got to remember, sometimes, again, the markets are going to move prior to these events. So it's not necessarily unusual to see something happen like the half point reduction on Wednesday without a major instant reaction, because, again, it already happened for us. But there's one other key piece here. So the Feds always announce comments along with any move or any meeting for that matter. So some interesting comments came out. The biggest one was, or I think the biggest focus for the market was, they mentioned a recalibration on their focus. So as we all know, the Feds have been hyper focused on inflation the last 3 years. And everything they talk about is, hey, we want to watch the data, make sure inflation is coming down, and we got to make sure to tame inflation. And before we can lower rates, we got to make sure inflation is good. So it's the number one focus that we've always heard. And that's how the markets reacted to say, hey, we know the Feds are focused on inflation, so we're going to key in there. Well, now they came out and said, we're going to recalibrate our focus away from inflation to employment. So this kind of rocked the markets a bit to say, well, we've been so focused on inflation and trading around and speculating around inflation data. Now we need to maybe hyper focus on employment like the Feds are. So I think that's part of the reason we saw a little bump in rates, guys, is things shifted. Not just that they lowered a half point. It was more the shift of, hey, how is the Fed's mindset going to be moving forward? And with their recalibration, announcement, now it's saying we're going to be focused on employment. So I think there's always that little bit of a cover your butt style trading from investors saying, hey, this is a shift. We're going to pad things a little bit. We saw rates bump a hair. Now, I think what we'll see in the coming weeks is traders, everyone kind of refocused to say, okay, hey, now the maybe key data points out there are going to be a little more focused around employment based on that's what the Fed's watching. So I think markets will absolutely normalize. I think we can continue to see a downward trend. I think it's very much expected to see the Feds make further reductions to the next few months here before the end of the year, as well as in 2025. It's just getting onto this new path of focusing around employment. So I think that's a couple of key pieces maybe to keep in mind for us. Ultimately, guys, as we think about it, we're still in an amazing position versus where we are. Even again, just 60 days ago, literally 90 days ago, massive difference in interest rates. So whether we have our buyers, our sellers, or the current homeowners, they're in a substantially better position today with much better mortgage rates out there. So that's a huge win in itself. And again, I think we'll continue to see positive movement. But I hope this gives you a little bit of context as to what happened on Wednesday, why we maybe saw a little bit of unusual reaction, and what to expect moving forward. So everyone, hopefully have a great weekend here. As always, anything you need, feel free to reach out, and the team and I are happy to help. Thanks so much. Take care. Bye.